Britain is a nation of homeowners. In fact, 63% of households in England owned their homes in 2020. While this is down from 73% before the financial crisis in 2007, England, and by extension the UK, is house mad. Home ownership is baked into the British psyche, with renting almost seen as a sign of failure or shame.
We want to change that with this video. Your home is where your heart is, whether it's rented, mortgaged or owned outright, but more than just the emotional argument, we'll show you that the finances work for renters too. Renting doesn't have to be just dead money, it can be your route to financial independence. Forget home ownership, here's 7 reasons to rent instead. Let's check it out. And by the way, we want to give a special shout out to commission-free trading platform Stake, who are sponsoring this video. Stake are the go-to investing app to buy and sell US stocks. There are thousands of stocks to choose from and they charge 0 FX fees when you trade.
Instead, Stake converts your pounds into dollars when you deposit money, so you only incur FX fees once, rather than every time you trade, as you do on many other apps. Stake are giving away a free US stock worth up to $150 to everyone who signs up via our offer link, linked to in the video description below. Number 1. Rent is dead money, but so is mortgage interest. A common refrain amongst aspiring homeowners is that rent is dead money, and they're kind of right. You're giving away hundreds of pounds a month to a landlord that you'll never get back. But it's not like buying a house on a mortgage isn't dead money too. Mortgage interest payments also cost you hundreds of pounds a month, and with the Bank of England raising the base rate from 0.1% to 0.75% since December, mortgage interest payments are only getting bigger.
It's not like you can reasonably expect to pay a mortgage off quickly either. With house prices sky high and now interest rates rising, it wouldn't surprise us if banks had to start offering mortgage terms even longer than the current maximum of 40 years. With the average age of a first-time buyer now 32, homeowners look likely to be paying their mortgages off in their 70s and having to endure mortgage interest payments until then. But with average life expectancy being just 81 years, this means that mortgage interest payments over a lifetime is hardly all that different from renting over a lifetime.
And as we'll soon show, not having your money tied up in an unproductive asset, your home, may make you quite a bit richer and so better prepared to pay rent in old age. Renters simply need to have their capital invested in an appropriate alternative.
Number 2. House savers are at the mercy of inflation. If you've ever tried saving for a house deposit, you will no doubt be painfully aware of how long it takes to reach your target. Some people are frustrated with the wait, see their big pile of cash sitting there uselessly and choose to invest part or all of it into the stock market. But those that do may find that this is a mistake.
Because of the volatility of the stock market over the short to medium term, you would want to keep a house deposit in cash for safety reasons, so it's there in full when you need it. Stock markets can drop significantly overnight, and this could scupper a house purchase and extend your wait for years while you wait for the market to bounce back. But sitting in cash and with inflation forecast to rise to as much as 10% in 2022, your savings are wasting away to inflation while you're chasing the dream of home ownership.
10% inflation would mean your house deposit loses 10% of its purchasing power while it's sitting in cash, potentially for years. Renters have no such concerns. They can simply put their savings into stocks, gold or other commodities and happily ride out any market swings, safe in the knowledge that their investments are counteracting the wasting effects of inflation.
Number 3. Homeowners have home equity. Renters have a freedom fund. If you're willing to go through the pain of saving up 50 grand or so for a deposit, have you considered how much income that money could be making you each month if you invested it into cash flowing assets instead? If you buy your home, your deposit and all your future monthly capital payments are locked away in the house, inaccessible, and not included in your available investment wealth, like an investment in stocks for instance would be. With house prices so high, that's a lot of money to turn your back on, which could be diverted into your freedom fund instead and invested to create yourself a second income.
Part of the joy of being on the property ladder is the growth boost that your equity gets from the leverage provided by a mortgage. Because you only put down a small deposit to buy an entire house, you benefit from the full amount of property price increases without having to pay for the entire house up front. For example, with a 25% house deposit, in a rising market your equity grows 4 times faster than if you owned the house outright.
You could get a similar investment benefit to home ownership by buying a buy-to-let property instead with your deposit and continuing to rent yourself. As a renter, you'll be familiar with the concept of handing over hundreds of pounds each month to a landlord. Why not put yourself on the other side of that equation? Let's look at the benefits.
They say your home is your biggest investment, but it creates no positive cash flow, no dividends, no interest receipts, and no rental income. If you buy a rental property for tenants to live in instead of a house for yourself to live in, you have an income for life from the rent, on top of getting the same capital appreciation you'd get from owning your home.
We've shown before in this video how I make 25% returns with buy-to-let properties. That's roughly 16% capital growth plus 9% cash flow profits on the monthly rent, or about £1,000 of gains per property each month on average. I like to think of the capital growth as being there for my future, and the income as being there to support my lifestyle now as a second income stream, though often it gets reinvested into other investments. If you're interested in investing in buy-to-let properties yourself in this way, check out our Find Me a Property service on moneyunshackled.com, where we'll put you in touch with our approved property agent, who'll help get you set up with your first high-returning buy-to-let property, or even source you a whole portfolio of them.
Number 4. Maintenance shouldn't be your problem. According to checkertrade.com, the average homeowner spends £848 a year on maintaining their pad. That doesn't sound like much until you consider that renters do not have this expense and could invest that money instead, and that homeowners suffer this expense for 50 years on average. This means that by choosing to rent, you could have used this extra money to build investments to the value of £186,000 in real terms at a 5% inflation adjusted stock market average return.
186 grand is a hell of a lot of money, and to put it into context, it is actually 3 times bigger than the value of the average UK pension pot at retirement, which stands at just £62,000 after a lifetime of saving, according to The Telegraph.
You see no return on the money you have to plough into a house over the years to keep it maintained. Keeping a house to the same standard does not add value to it. And adding things to the house like a conservatory doesn't necessarily add value to the house either. For instance, if it means you lose garden space, though the work may set you back £20,000. When you rent, you don't have to think about maintenance at all. It's someone else's problem.
Number 5. You're tied to the house. Being a homeowner can sometimes feel like being a prisoner. You can't just easily take a gap year and go swanning off around Southeast Asia. Who'd look after the house? You can't move city to pursue a new job or life's opportunities without a terribly slow process of upheaval, from putting your house on the market, finding a buyer, and waiting for the sale to go through. Plus, you'll often have to pay 2 lots of housing costs while you wait for your old place to sell.
When relationships end, which they do all the time, you jointly own an asset with someone you may not want to be around anymore. A recent survey by goodmove.co.uk reveals that 56% of couples have called it quits after moving in with a partner. But the drawn-out manner of selling a house often means couples are forced to cohabit for months after a breakup while they wait to get their money back when the house sells to use as their next house deposit. Research by Direct Line Home Insurance reveals that on average, cohabiting ex-partners must stay living together for 4 months before they can afford to or are contractually able to move to a new home. When you rent, one or both of you can move out more or less immediately.
Number 6. No property taxes for renters. Stamp duty. It's our number 1 bugbear in the property market, perhaps the most unnecessary and damaging of all taxes. With charges hitting the £10,000 mark on the sale of a 400 grand house, stamp duty serves as a blocker to free movement in the housing market, stopping people from moving home out of fear of being robbed by this excessive sales tax.
With the average UK property now valued at £271,000, the average mover faces a stamp duty charge of £3,550. Other sales costs including estate agent charges, solicitors' fees and moving fees can easily double this outlay. Likely due to the existence of these excessive sales costs, the average homeowner sells up and moves only once every 23 years according to research by property site Zoopla.
This still means you'll likely be stung by stamp duty at least twice in your life, assuming you get a first-time buyer exemption. This contrasts starkly with the average moving rate of renters who, unencumbered by stamp duty and a costly moving process, move house on average once every 2 years, with housing charity Shouldnt describing renting families as nearly nomadic.
While shelter means this as a negative, we see the phrase nomadic as being a positive thing in the sense that renters have their freedom, since if moving house for homeowners were as easy and cost-free, we suspect people would sell up and move far more frequently.
Number 7. You can't control the interest rate. One of the biggest worries for homeowners right now is mortgage interest rates, following the recent rise of the base rate to 0.75%, and concerns that it will rise further above 1%. For landlords with a strong cash flow, this represents a dip in their profits. But to a homeowner living on the breadline, it could spell financial doom. While most mortgage holders choose to fix their rates on 2 or 5 year deals, once those initial periods end, they'll find they are stuck with a poor range of options.
An £800 a month mortgage payment might be split roughly £400 capital and £400 interest. The homeowner may find that with an interest rate increase on the mortgage from 2% to 3%, that their £800 mortgage payment turns into a £1,000 mortgage payment. Incidentally, an interest rate rise from 2% to 3% equates to a 50% increase in the cost of servicing your mortgage.
A renter, meanwhile, is unlikely to see their rent increase by 50% over anything other than the very long term. Their landlord bases their rent mostly on what other renters in the market are willing or able to pay, and so rent is linked more to national wage rises than interest rate rises. While homeowners are stuck battling the fallout of a decision by the Bank of England to raise rates, renters may simply see an inflationary rent rise. A £600 rent may increase to £650 with inflation in 2022, for example, which may feel painful, but is nothing compared to the perhaps 50% rise in homeowners' interest costs this year.
Question of the day: do you still want to own your own home? And if so, why? Join the conversation in the comments below. Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.